Hi there, and thank you for joining us here on PhillipCapital's Market Watch. I'm Sze Han, Assistant Manager from PhillipCapital Contracts for Differences, CFD. In the US, a stubbornly high inflation and whether the Federal Reserve can successfully tamp it down without crashing the economy are front and center concerns for the US stock investor. In this episode, we'll be talking about the challenges the US economy is facing and the outlook for the US stock market ahead. US Consumer Price Index for July came in at a moderate 8.5%, a sharp drop from a scorching hot print of 9.1% from the previous month and cooler than market expectations in general. Core CPI, which excludes changes in food and energy prices, was flat month-on-month and lower than market forecasts. The softer than expected CPI prints lifted investor sentiments and stocks jumped on revived optimism that the Fed now has more leeway to shift to a less aggressive pace for interest rate hikes. The US stock market had taken quite a hit in the bear market downturn that started around January this year. In the 6 months from January to June, the S&P 500 underwent a peak-to-trough collapse of 32%, while the Nasdaq suffered a crash of 53%. However, after hitting lows in June, all three major indices had bounced back significantly. In the short 8 weeks from June to August, the S&P 500 had recovered by 16%, while the Nasdaq had regained 22%, technically putting the Nasdaq back into bull market territory. The quick V-shaped rebounds in the indices had many investors questioning if the current recovery is sustainable or whether it is buoyed by false optimism that could dissipate just as quickly when the next wave of bad news hits. And indeed, market naysayers may have valid reason for dousing cold water on the current rally. For one, despite the softening in the latest CPI data, inflation in the US is still at a 4-decade high. Notably, shelter prices, which account for approximately 1/3 of the CPI weightage, remain elevated and are up 5.7% year-on-year. Medical and transport services, which account for 7% and 5% respectively of the CPI weightage, are also up significantly year-on-year. As price changes in shelter, medical, and transport services tend to be stickier, we are likely to see core inflation persisting at above 4 to 5% for a while. In that scenario, the Fed may continue hiking interest rates until inflation is back within a more acceptable range. Since March of this year, the Fed have been hiking interest rates aggressively in efforts to dampen demand and to rein in high inflation. At the last FOMC meeting on 27 July, the Fed had announced a second consecutive rate rise of 75 basis points, bringing the Fed funds rate to a range of 2.25 to 2.5%. Current market expectations are that the Fed will hike interest rates by another 50 basis points at the FOMC meeting in September, and that they will keep hiking interest rates through the rest of 2022 until rates reach at least 3.5% by the end of the year. Can the US economy tolerate rising interest rate and avoid a hard landing? There are reasons to believe that it can. For one, there is the tightness in the US labor market. US unemployment rate is currently at a 50-year low of 3.5%, and the latest job report showed that more than 500,000 new jobs were added in July. This is much more than numbers in each of the previous 4 months, and more than double that of market expectations. In the same report, average hourly wages and weekly earnings were seen rising across the board, suggesting that businesses are still having to offer higher pay to fill positions and to retain workers. A recent survey by the Bureau of Labor Statistics showed that there are currently 2 job vacancies for every 1 job seeker in the US labor market. We will also have to consider the spending power of the US consumer. Data from the US Census Bureau released last week showed that US retail sales held steady in July 2022. While there were declines in auto sales and gasoline spends, these drops were balanced out by equal-sized gains in other retail categories. The overall strong numbers in July's retail sales report showed that despite high inflation and talks of a looming economic downturn, US consumers are still spending and demonstrating spending resilience. The strong US consumer as well as the tight US labor market are some reasons why US stock market bulls have pushed back on talks that the US economy might fall into a deep recession. There are, however, signs that parts of the US economy are slowing down. GDP data, for example, showed that the US economy had contracted by 1.6% in the first quarter and 0.9% in the second quarter. The 2 consecutive quarters of negative GDP growth place the US economy in a technical recession. On the US housing front, the effects of higher borrowing rates are starting to bite. US 30-year average mortgage rate had risen from 3.22% at the start of this year to 5.22% in August. Data from the US Census Bureau released recently showed that new US home starts has dropped to a 10-month low, while existing home sales has dropped to a 2-year low. Total mortgage applications to buy or refinance a property also continue to decline, in another sign that demand in the housing market is cooling. We are also starting to observe some weakness in the US labor market. Jobless claims, for example, have been on the rise since April this year and are currently near a 9-month high, suggesting that some of the tightness in the US labor market is easing. In recent months, major tech firms such as Tesla, Meta, Amazon, and Apple have also announced that they are pausing business expansion plans. They are also stopping new hires and starting layoffs, in another sign that the US labor market is starting to weaken. Still, it can be argued that the cooling of the housing market and the rise in jobless claims are desired outcomes of the Fed's tightening action as they try to curb demand and ease price pressures off from the overheated US economy. So is the current stock market rally durable, and can the US avoid a hard landing? The softer than expected CPI print had helped to substantiate the stock market rebound that started in June, and barring unforeseen shocks that could cause price pressures to ramp up again, the positive sentiments in the stock markets may last for a while. However, investors are advised to exercise caution in trading and to understand the risks in chasing the rally here, as we will still need to see continued easing of inflation for the next few months before we can say with more conviction that the US economy can avoid a hard landing and that conditions are in place for a more sustainable recovery in the stock markets. And that's all for this episode of PhillipCapital's Market Watch. Do remember to like and follow us on social media and to subscribe to us on YouTube. Also, tell us your view. Is the current US market rally durable, or do you see more downside to come? Leave your comments. Thanks for joining. We'll see you soon.